Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. And for anyone interested in what Whole Road platform looks like for family offices, please reach out at Shaun, so it's SHAUN, at wholeroad.com.au, or give me a ping on LinkedIn. In this episode, I'm going to reflect on, will the total portfolio approach to investing work in a family office?
This is the Family Office Sherpa.
So what do I mean by the total portfolio approach? So my business is, a part of my business is selecting wealth managers and counterparties for family offices. But also it's about talking to people, to understanding what others are doing, what they're looking at. And a big part of that is talking to people that manage institutional money, either currently or they might be looking at the family office space. I'm always happy to talk to people like that because they bring with them curiosity a lot of the time and a willingness to understand what the differences might be within the family office as opposed to other asset owners, industry and pension funds, things like that, sovereign wealth funds. Anyway, what has struck me around those conversations is how different they have to be in terms of their mindset in approaching investments a lot of the time. So one of the starkest is around the framework. So institutional investors tend to operate within really clearly defined and structured investment frameworks because they have to. A lot of the time they're answerable to government. They're very heavily, compliance regulated. There's beneficiaries. There's sometimes significant amount of complexity. Let's just call it that, right? And so they have to be really disciplined. The framework has to be really, really specific. Whereas many family offices are much less constrained by that and often led by a single decision maker. It can be the family member, it might not be, and ultimately there's a much lower number of beneficiaries. So, and this is what prompted this episode. So there's been conversations on LinkedIn and the press and things like that around this total portfolio approach, which if I get this right, and please understand that my role is not to be the investment manager here. Mine is to interrogate this. And this is really more of a start of a conversation. But as I see it, the TPA or total portfolio approach treats the portfolio as a single sort of more unified pool of capital rather than a collection of separate asset classes. Instead of being buckets, across predetermined sort of asset definitions and things like that, managing back to policy weights. We've always we're overweight equities, we're underweight fixed income or something like that. This is more aligned to that strategic asset allocation model and the one that, a lot of families, and myself included, in terms of that's what I know well. What TPA kind of asks is, what is the best use of the next dollar of capital relative to everything else already held in the portfolio? So what's not necessarily what's the asset allocation? It's more, what's the best use of our next dollar, basically. So, it originated with large institutional investors, organizations with deep investment teams, very sophisticated risk infrastructure, and really ultimately the staff and the analytical horsepower to run it, right? Now, what I'm curious about is whether a family office, which, a lot of the time is run incredibly leanly, and with a fraction of that sort of resourcing and capability and a very different set of governance realities, because ultimately, there's a lot less in terms of that compliance burden. Can they meaningfully adopt a version of TPA or TPA, or whether it ends up being a label that sounds great, it sounds, entrepreneurial. We're talking about taking opportunities where they lie rather than at the bucket level. Or will it create more problems than it solves? So I thought I'd dig into that. So what I'm going to do is I'm going to do sort of 5 points where I think it would work and 5 where it probably doesn't, and let the conversation sort of start from there. So let's start with where TPA kind of fits, in my opinion, with the family office, where it would fit well. Number one, the whole balance sheet is actually just one big portfolio. So most families don't separate wealth into really nice, tidy asset class buckets in real life. It's complex. It's got nuance and shades of grey and things like that. They have a business. They have direct property assets. They have share accounts and private deals and syndicates and all sorts of things, right? A total portfolio reflects that reality to a certain degree. And strategic asset allocation almost pretends that the investable portfolio exists in isolation, where it rarely does in family offices, right? So I think that's where it works. Number two, there's no external beneficiary to justify the decisions to. So strategic asset allocation is rigid in parts about accountability and a really diverse number of shareholders. So trustees, members, regulators, things like that. A single family office answers honestly to one principle a lot of the time, or one group of principles. And that removes the biggest structural reason to maintain these policy constraints and allows to create spaces to generally optimize rather than defend a benchmark or something like that. So this is why, when family offices talk about the endowment model and things like that, I think this is where they sort of think about what's the use of benchmarks if they're just a constraint against opportunity. Anyway, number three, private markets fit more naturally into this kind of strategy. So families often hold illiquid assets, direct property, private equity, operating businesses, that don't sit necessarily in that strategic asset allocation framework. If you've got an operating business, and this is a question that comes up all the time, where do we sit that operating business? Should it be part of the portfolio? Is it investment portfolio? Is it private equity? If we've got a loan to them, is it private credit? All these sorts of different things. So it doesn't always fit that well into that framework. You can kind of make it, and it's all really around expectation management a lot of the time, but the TPA doesn't try to force them into a bucket. It asks what each holding is it contributing to the overall portfolio performance, which to a certain degree is a much more honest way to manage a balance sheet, especially one that's illiquid by nature, idiosyncratic by nature, things like that. So that's where it kind of fits nicely in there. Number four, it often matches how principals think. Most family office principals don't wake up worried about their deviation from a 30% international equities weighting or something like that. It's not necessarily how they think, especially if they've built a business. They think about risk, return, and whether capital is working hard enough across everything they own. Like it talks about, which is the dollar out, and what's the dollar that we're getting back. And in TPA starts from that perspective. So kind of the way that you think about it kind of aligns to that entrepreneurial sort of mindset. And that often produces better conversations in investment committees and better decisions overall, rather than we are overweight this bucket, therefore we need to bring it back to weight. It's more, is this a decision that we're comfortable with? Should we be overweight? And that's our comfortable decision. Number five, it supports long-term multi-generational mindset. So strategic asset allocation typically anchors offices to that shorter-term return and risk, right? Whereas TPA is inherently more dynamic and much more goal-oriented, which suits families across a multiple generation. I guess what the question asks is, what is this portfolio trying to achieve, rather than are we within these policy bands? Which is often a much more relevant question for a family with a 50-year time horizon. So they're the five that I think it matches up in terms of the way that family offices think. Now, this is where there's a challenge. So where does this TPA not fit within that family office structure? Number one, most family offices don't have the investment team to run it properly. It is very sophisticated portfolio construction. It requires dynamic risk management and really heavy ongoing analytical rigor. that's why, it's why it works for a lot of the big sovereign wealth funds and large endowments, because they've built these big teams. A single family office, or, even a small multi-family office, typically doesn't have that capability in-house, which means that if you take on this more TPA style portfolio management, it becomes a label rather than a discipline, right? Number two, without clear benchmarks, accountability gets murky. I'm a massive fan of benchmarks because it often in family offices, you don't tend to get that. No one's gauging it. No one's benchmarking against an alternative, right? So strategic asset allocation really gives you a policy portfolio to measure against. If returns come under expectations, you can trace that decision back to the framework that we've established, right? So, but TPA relies on judgment calls and things like that, which works well. Well, hopefully works well in good markets, but ultimately when it all unravels or we get a lot of red across the book, someone needs to explain why we had certain investments and why the portfolio looks the way it did in that part of the cycle. And that is a very, very tough conversation to have. In my experiences, principals that have potentially built their entire lives building up this wealth do not like surprises, especially on the downside. Number three, the TPA approach makes the investment policy much harder to write and much harder to enforce. So, as you know, I'm often used. So, the Whole Road platform is there for families to tap into to help with investment governance, and a lot of the time that is the investment policy, right? And under that investment policy, there's usually a very clear strategic asset allocation. It has ranges, it has rebalancing triggers, it has compliance checkpoints. Under this TPA approach, the policy is more principle-based and harder to, operationalize. In practice, many offices that, claim to run more of that TPA style, it doesn't reflect it in the IPS. And I think that's potentially where I see a lot of it. Maybe the TPA is just another word for the way that family offices kind of run their portfolios when they don't have an investment policy in place. It's what's going to be the most interesting, what's going to be the most engaging investment, not necessarily how it's going to affect the portfolio long term. So it's kind of an interesting one. Which is why I wanted to do this episode, because on the face of it, this TPA approach kind of aligns itself nicely to an entrepreneurial, taking opportunities as they come up kind of investment style. But it's really hard to put into a policy. It's very hard to engage people with it, because ultimately it almost comes down to, a lot of the time, if the framework isn't institutional size, it's one person making these decisions. So I think that's a really, really important one, and one where it becomes too much of a challenge. Number four, it can be used to rationalize a lack of discipline. And this is the more uncomfortable one, right? So the flexibility of TPA is a genuine strength in the right hands, right? In the wrong hands, or the hands, when I say the wrong hands, but in the hands of someone that's less rigorous around analytics, more inclined to make decisions with their guts or something like that, it can become a reason to avoid those hard conversations, which we've all had in the family office space, which is big overweight positions, concentrated risks, holding legacy positions where nobody wants to sell. You could sort of almost frame it as like, well, we're not selling it because it's a total portfolio view. And it ends up being an investment philosophy or a polite way of saying we just don't really have the framework in place, and then being able to tell the difference between a TPA and a no framework approach, that's the hard question. So number five, this is the last one. So it's incredibly complicated and hard to just justify that increased complexity. If you listen to the past conversations on my podcast, and these are reflective of the ones that I'm having, offices are becoming or seeking less complexity, not more. They're seeking easier to engage with portfolios and policy rather than adding complexity to it, right? Moving to total portfolio approach isn't just a philosophical shift. It would require rebuilding the whole governance and reporting infrastructure. It would, we've been running strategic asset allocation models potentially for years. So we've built it up through the counterparties understand it, our reporting structures understand it, and our investment committee processes are all built around that. And, there's a good argument for long-term strategic asset allocation for family offices. And that's a significant undertaking to change that. And most officers don't have the appetite or underestimate what's involved. And I think this is why I wanted to have this conversation now, because if you're in a family office investment committee or you're in family office generally, and people are starting to talk around total portfolio approach or dynamic asset allocation or whatever it ends up being, like different names for the way that the portfolio is run, it's just good to have these conversations. And I really enjoy having these conversations, and it's worthwhile digging into it. There's a really good article, which I include in the show notes, from i3, where they go through the difference between the SAA approach and the TPA approach. I just think it's a really good conversation to have, but I think the family office space is more aligned to, unless it's a specific kind of endowment or something like that, is more aligned to, these are the buckets that we have. These are the asset allocations. These are the names. These are the criteria associated with the way we invest in each one of these buckets. This is the purpose of each one. This is our long-term capital market assumptions for these. And then we backfill it to our total return expectation. And it's simple, and we understand it, and it has rigor. And that's, I think that's where the family office space, does align to that more strategic asset allocation. But a good conversation to have. If you're enjoying the podcast, please ding the little bell. It helps get numbers, and if you think that someone might find this interesting, please forward it on. If you're interested in more content like this, then there's the Family Office Sherpa newsletter, which comes out every 2 weeks. You can find that on wholeroad.com.au. Until next time, thanks for listening.